let's get into it. Understanding your financials. So the first thing I want to do is just talk through the basics. I'm not using a full-blown PowerPoint today. Today we're gonna kind of go between both. So first, we have your profit and loss, which is your income statement. This is the most popular report, if you will. The one most people have heard about. They kind of know what it is, but let's break it down. Basically, it's what a company makes and spends over a certain period of time. If you are using accounting software, you'll be able to go in and put what dates you want to see for your P&L. It's where it's showing your income, otherwise known as revenue, and then your expenditures, otherwise known as expenses. So you have income, your cost of goods or services, maybe, and then your expenses are listed all on your P&L. Essentially, it shows you what's left over after everything is said and done in terms of operating expenses, income that's coming in, and all of that good stuff. So this is where you can find your gross profit. This is where you can find your net profit. And it's where you're going to look for most of your information to see what's happening on like a day-to-day basis. Now, the balance sheet is going to show you what a company owns and owes at a particular period in time. It's also the numbers on a balance sheet are rolling over. So they roll over year, month over month. So it's different from like the profit and loss, which is just that snapshot. The balance sheet is going to show you the snapshot, but it's going to be from everything up until that point. It's going to show your assets, it's going to show your liabilities, and then it's going to show the equity, which can also sometimes be known as capital or net worth. Banks love balance sheets and lenders love balance sheets. And the reason why is because it tells you basically like the health of your business over an extended period of time. It's going to show you how much money you got in the bank. It's going to show you how much you owe to other people. It's going to show how much money you've kept in the company year over year, how much you paid yourself, if there's been any kind of like contributions into the business or inflows of money from the owner or partners or whatever, what have you. All of that is going to be listed on your balance sheet, which is why banks like that, because it's going to show where you're at. Like if you've had, even if you're having a bad year, looking at your balance sheet is going to show were you prepared for it? Do you have money saved up? It's going to show you if you had a great profit, do you still owe a lot of people? If you have money that you had to put in constantly, or if you've been able to pay money back. So it really shows the health of the business, which is really what lenders are looking for when they're trying to figure out if they want to fund you or not. Okay, and then finally, the last report we're going to talk about today is the cash flow statement. And if you watch my video, my masterclass last week, we talked about cash flow a lot. So if you're not sure what's going on with cash flow, or if you don't feel like you have a good grasp on it, go back and watch some of the other master classes that we've done, because we've been talking a lot here and there about it as well. But basically, cash flow is the money that's coming in and the money that's going out. And you know what? I just realized that is not where I talked about it. I'm going to be speaking, but they were pre-recorded speeches, and that's what I was talking about. And I had to record it a couple of times. So that's where we talked a lot about cash flow and that, but there are some videos in cash flow. So if you need some help on that, or if there's anything in here we're like, Megan, I need to dive into this a little bit deeper, drop me a comment, because I either have a master class already about it, or we're going to be coming up into one, or I can make one because I love teaching and creating these kind of educational things. Okay, so anyways, let me start over. A cash flow statement is going to show you where all of the money is coming in, so your inflows, and then where all of your money is coming out, your outflows for a period of time. So it kind of gives you that whole picture of what's happening in your business. I like to say that it combines the balance sheet and your profit and loss, because your profit and loss is great to show your income and expenses, but what it doesn't show is loan payments or credit card payments or loan money that you received. So it doesn't always give like the full complete picture of what's happening. That's where that cash flow statement comes in. Okay, so now I want to actually dig into what these reports look like. So let me move over to my PDFs. Hopefully this is working the way that it's supposed to. I was having an issue with my computer. Which, fun fact, if you're the owner, did you know that you should have a bigger running RAM or processor or whatever compared to everybody else on your team? Because apparently owners use a lot of data or room or something. So, anyways, I have the wrong size computer. So, my IT guy is helping me get that figured out. Oh, okay, hold on. Let me stop sharing for a second. Bear with me, please. Sorry. Like this. Trying to get them all in one screen. Okay. All right. So let's talk through first profit and loss. So when we do reporting for our clients, we like to run this profit and loss by percentage of income. And I love this method of reporting because people understand percentages way better than they understand like flat numbers. So like, let's say for instance, we're looking at this P&L and all we see are these numbers. And the numbers are great. Like in this first column here, right here, this column here. Numbers are great, but if you're looking at them after a while, it can be kind of hard to digest. So we like to run this percentage of income because for one, we're able to pull information out like profit margins. So this is like the cost of goods sold for this company. And this is like catering. I think it's like a cake company. So there's catering and food supplies. That's going to be their main cost of goods. It's probably owner operated. So there isn't like any owner salary. They don't have staff. Um, or they do have some staff. It looks like there's some staff here, but not a ton. But the staff might be doing other things. But the cost of goods is usually related to the direct cost of producing your products or services. So you can set up your chart of accounts to reflect this so that when you look at your profit and loss, you can see what your profit margin is. Now, this profit margin is 37.63. And even if we added in this 12 or 13% here, that would drop it down to 24%. Now, 24% is a really low profit margin. Usually you want your profit margin to, it depends on the industry, but generally speaking, you want it to be around 40%. So 37.63 is maybe not as bad, but I'm thinking probably some of this cost of labor should probably be up here in cost of goods or services sold. So even if we took half of that, that would make it to 31%, which is pretty low. So 35, at least 40% is usually around the mark you want to hit for that. But on that note, this company will be able to track these numbers and make that a data point, make that a KPI. So every month they can take a look at what their gross profit margin was. The other one that's usually good to track is the net profit margin, which is going to be this one down here. So after everything is taken out, what is your net profit margin? Now, why are these numbers so important? Well, I'm so glad you asked. They are important because if your business does not have a good gross profit margin, it's not going to be able to cover all of your overhead expenses, which are typically these things like advertising, bank fees, insurance, legal and professional fees, merchant account fees, rent expenses, telephone expenses. All of those things that are not directly related to producing the goods and services are your overhead expenses. So if your gross profit margin is not high enough, it's not going to be able to cover these expenses. And even worse, is not going to be able to cover your pay. Because typically an owner's pay, unless you are truly doing everything, is going to be part of overhead and not part of the deliverables or the cost of services or goods sold. So you want to have that be a good number. And then same thing down here, like especially if you're not on payroll, that means this percentage needs to be high enough where you're able to pay yourself. But the point is that it's a metric that you're able to now check or track, check and track for future reference as you're operating your business. Another thing it can help with is monitoring these different areas of expenses. Maybe you're trying to cut down on meals and entertainment, for instance. Now I can take a look at like, okay, what percentage of my revenue was I looking at that? And let's go over here to give this as a further example. So this is a comparison year over year with the percentage of income. So you'll see that their income increased quite a bit, from one year to the next. But if you take a look at some of these expenses, let's see here. What's a good one? Okay, so like shipping expenses for one, like this would be a good one to track. So like here, there's $4,000 in the one year and then $9,400 in the next year. If I were simply looking at these numbers, I'd be like, oh man, that's like a big jump. But when I take a look at the percentage of income, and this particular expense makes sense that it would increase at the same rate that the revenue was increasing, right? Because if they're selling products and shipping those products, then in theory, those costs should be pretty similar based off of the income that's being received. So, and that's exactly what we see here. So, as the income increased, the shipping expenses also increased, but they stayed the same percentage of the total income. So that means that it grew at a good rate. So looking at things like that can help keep that view and perspective. And it makes those numbers more tangible to track. Now, whenever we're looking at example reports, I know it's always hard. It can still be hard to be like, okay, this is great, but like, what about me? The thing is that as you're looking at your reports, you're gonna understand the story more. So like as you're looking at it and you're like, okay, well, what happened here? So like for instance, if this was your business and this year you didn't have any events and then now this year you did have events, well, you know that you started going to more events, right? If you went like this one here, so in 2019 there was a lot of supplies that happened, and then in 2020 there was a lot less supplies. Well, one of the explanations for that could be that they found a better supplier and they didn't have to buy as much like startup goods or something related to that. So that could be one main reason why that happened as well. The shipping expenses stayed the same or similar. Professional services went up. Well, if this was your company, you would have the explanation behind that. Maybe you hired a coach, so your expenses were higher, but that also made your revenue, it had an impact on your revenue. So that was a good ROI. So hopefully you're seeing the line, the comparison here. That looking at your reports from yourself is going to make a lot more sense than just looking at these practice or example reports. The point is that I want to make for you and to drive home is that looking at your numbers is important. And the more you look at it and the more you ask yourself, okay, why did this happen? What decision did I make that impacted this number? The more you're going to begin to understand your business and how your decisions affect your money and what shows up on your reports. Okay, so that is the P&L. We looked at the income. There's probably some cost of goods or services sold, and then all of your expenses. Then we have our gross profit margin, which is this number up here, and your net profit margin down here. And so as you can see too, this is showing that the business was operating at a loss for 2020, which, surprise there, right? 2020 went really well or really bad for lots of people. Okay, so then here is the copy or an example of a balance sheet. So these people are using the profit first method. So they got lots of accounts set up there. There's some accounts receivable here. There's some raw materials. There's some finished goods inventory here. And then they had some payables, some credit cards, some taxes that are payable, lines of credit, gift cards. This is like if they're they have gift cards. That's a liability if you offer gift cards to people in your business or customers, for your business, because then when it gets redeemed, then it gets used. So a couple more loans here. And then this is your equity area. So this is going to show how much the business owner pulled out. Retained earnings is like how much was kept in the business. And then net income is going to be your net income. That correlates to the P&L, which here is the P&L for this period, an example for that. So we've got some product sales here, really good profit margin going on there. Wages, I don't see any owner's wages. So like in this instance, in this example, this 16%, this needs to cover the owner's pay as well. So distributions, draws, in this example, because there's no owner's payroll, this is employee payroll. Usually if it's owner's payroll, you're going to want to mark on your chart of accounts owner's payroll so that you're able to snapshot and look at this like that. Looks like there's some additional cost of labor that's direct for that. But then let's go down here. So the number for the net income is 30,454. On your balance sheet, that number is going to show up here as well. So 30,454. So that's how those two things kind of connect to each other. So, but basically this is showing all of your assets, cash, receivables, which is money owed to you, any inventory, and then your liabilities, which is going to be money that you owe. So payables, credit card, taxes, credit or loans, lines of credit, all that good stuff. Okay, so then finally is your cash flow. So this is your cash flow statement. It is going to show you the money that's coming in. So from January to May, it's like this company operated at a loss. So I had a little bit of a loss. This whole area here is to like reconcile cash to income. So operations, there was some money that was paid, borrowed some money against the credit card, paid some pay or sales taxes. So the total difference to adjustments to operations was this 4,000. So that brought the net cash to 3,000. And that's mostly because they borrowed against this credit card. So that's kind of like cash going into the business, essentially, because you're able to buy. And then the CIMB loan, these were loan payments that were going against those. Owner's draw pulled out for our owners, pulled $600 or $800. So then the net cash was 5,000. So the net cash increase for the period was 82. Was actually net cash decrease. Anyways, the cash at the beginning of the period was 25. So the cash at the end of the period was the 17,000 because essentially they had to finance. Oh, minus. There's the minus. I was like, wait, that's not right. Okay, minus. So that's what I was gonna say. Minus 8,200. So basically, of all the activities during the month, or through this period from January through May, they had to borrow or infuse cash into the company and basically use what was there. So they had $25,000 in cash during that period at the beginning of the period in January 1st. By May, now their balance is down to 17,000 because they had to use the cash that was available because the operating activities during that period of time was not enough to increase the cash balance, right? So they had more outflows during this period than inflows, essentially. And that is really the biggest things that you want to look for here when you're looking at your cash flow. In theory, you want your cash balances to always be stable. So looking at your cash flow on a monthly basis can give you a lot of information. If your cash balances at the end of the period are constantly fluctuating, going up and down and up and down, you have a cash flow problem. So either you're not pulling in cash quick enough, either your profit margins aren't high enough, like it will tell you a whole host of information. But really what you want that to do is to be stable, right? You want your business to be bringing in as much as it's pulling out. And when it's not, that's when something typically needs to be addressed. Maybe there's too many expenses. Maybe you have too much debt, and you need to work on, putting that down or reconsolidating or something like that. So there's lots of different solutions. But again, point is to look at your numbers so that you know what you should start looking for. And then, of course, you can utilize different tools and graphs to be able to make this easier to look at. So let me see if I can pull some of that up. Okay. So QuickBooks is great for this. Let me see if it timed out on me. So give me 1 second, please. Yeah, so there's lots of different solutions that you can use if you're using any kind of an accounting software. Typically, they're going to offer some kind of like graphic that you can do. You can also make your own graphics in like Excel, and most of the time reports can be pulled into Excel to look at. There's also a ton of different organizations and companies that will give you more reporting. But basically, if this is the first time you're doing this and like this is new, like the numbers part is new to you, I would recommend simply tracking your gross profit margin, your net profit margin, and then maybe what like your ending cash flow balance is month over month, maybe the beginning and ending, so you can just kind of have that comparison. Otherwise, if you go into your QuickBooks, there's a lot of graphics that are already available to you. So like this has like the profit and loss for a period of time. This is just a sample file. So it's going to show you like net income and expenses, and you can click on those things. Over here, it's going to show you like the expenses you have. You can also go into reports and look at management reports. So there's like the company overview reports, which thought had the graphics in here. This is going to be like your the reports we just looked at, your profit and loss, your balance sheet, your cash flow. You can also customize that. So if you want to get creative and in QuickBooks, you can definitely do that as well. I got all these screens in the way. Okay, so let's look at this. Was like a sales performance. Preliminary pages. No, I don't think it's right now. Preview. Okay, so management, maybe profit and loss. There's the accounts receivable detail. So you can create the reports in QuickBooks as well to match, and a lot of other softwares will allow you to do that as well, to be able to get what information you want to pull from or see. You can see that in here. They had like a dashboard one, but maybe that's just on the dashboard now. But you can also do that. They also have this planner feature where you can start cash flow planning a little bit more. So if you're interested in doing that, or if you have a hard time with cash flow, you can certainly do that. You can move these windows around. So like if I wanted this to be up here, this is getting more into QuickBooks, but the point is that you want to take a look at what information you need to have that's going to be helpful for you. QuickBooks does do like this cash flow trend, report. So kind of what we were talking about, like making sure they're staying the same. You can create a graphic like this in Excel as well. But dashboards can be helpful. Usually you just have to set it up the one time. If you are not very good with Excel, like this would be a great thing for like Fiverr to do. If you go on Fiverr and just have somebody do it, real quick for you or something like that, to set up an Excel sheet for you. I have a really simple cash flow sheet as well. I talked about it in one of the other master classes. But that's usually a bigger concern for people, is like, how do I know what's coming in, what's going out? You can set up all the graphics you want, make it look all pretty. As much as you want, but if you're not looking at it, like, then it doesn't do any good either. So just make sure that whatever you're doing is simple enough that you can keep up with. It's going to be simple enough that you're going to continue to look and use it, because otherwise, like, there's not really like big points to doing that, right? There's no point in doing it. Um, okay, so we went through, I think, everything. We went through profit and loss, which is going to show your income and expenses, the balance sheet, which is going to show you what you owe and what you own, and then the cash flow, which is going to show you all of your inflows and outflows for your business. The key numbers that you need to focus on, like I said, we're going to keep it simple: gross profit, net profit, what your cash flow balances are month over month, inflows and outflows. That's going to really help you to see if your business is, your money is stable. And a lot of times it's going to help you identify which areas it's not, because if you're operating at a loss, well, there you go. Your profit margins aren't set up as well as they could be. So maybe you need to go back and look at your pricing. Maybe you need to go back and look at your expenses. If your balance sheet is showing a lot of debt, it's eating into your cash flow. Think about what you can do to consolidate, what you can do to start working towards paying that debt off. Like, there's those hard questions sometimes that we have to ask ourselves, like, what are those things that we need to do to adjust to make it? And if you're like, I have absolutely no idea, like, I'm here for you. Like, please reach out. We have some things that we can help you to get on track, or to like know what the first steps should be. So I can have that conversation with you so that you can figure out what your next steps are. And then your cash flow, like if your cash flows are like constantly up and constantly down and they're not very even, like that's a cash flow problem. Maybe it's a matter of timing. I have a client that we just did this with. Like we stabilized her cash flow, because what was happening was that she was billing once a month and she was paying her contractors once a month, but at different times. So she'd bill like on the last day of the month, and she's paying her contractors on the 15th. And so she was finding that, she wasn't getting paid until after the 15th. But she had to pay her contractors before the 15th. And so it was like creating this mismatch. So what I advised her to do was to start billing her clients twice a month and paying her contractors twice a month. So now her money's more stabilized, because typically when you invoice quicker, sooner, you get paid sooner. So just like making those two little movements like helped her to have a more stable flow of cash. Like her cash was more stable. So sometimes it's not anything like super huge or like big adjustments. It's just these little tiny things that add up and make big impacts into your profit and into your cash flow. And when you sit down and you take a look at your financials, and even if you don't fully understand it, you start looking at them and you start asking questions, you're going to start to know more, and they become more tangible. And then you can use them to make better decisions for your business and make those small adjustments that have really big impacts at the end of the day. So don't let your financials overwhelm you. You don't have to. Make sure you're doing your bookkeeping, or you have somebody that's doing your bookkeeping, and start asking questions. Like, we love when our clients ask questions, because it challenges us to make sure that we're doing what the best work for our clients, but then it also helps our clients to start digging more into their numbers. And honestly, that's where the magic is. That's where things actually happen, is when you can start paying attention to your numbers. After all, like, we can do your bookkeeping, but you're the one running your business. So you need to know this information, even if somebody else is putting it together. But make sure you're asking and you're being part of that process in some way, shape, or form. Okay, so I think I'm a little bit over. Thank you for sticking with me. I didn't even look on Facebook. I don't even know if anybody's watching this live, but if you are, thank you so much. And if you have any questions, please let me know. Reach out. I am here for you, here to help you be successful, and you can be. So just start doing it. Work little by little. Start looking at your profit and loss. Start looking at your balance sheet. Start looking at your cash flow statement on a more consistent basis. It is going to help you immensely. And if you need more help than that, we're here for you. So thank you. Have a great Tuesday. And I will talk to you next time. Thanks. Bye.